So like I was saying, yes, last time we started with a new topic that is substantive procedure, and we were able to look at substantive procedure from introductory point of view, right? We talked at length on what is the meaning of substantive procedure. We look at what instance do we conduct substantive procedure, okay? We also look at some aspects of financial statement assertions, because when you're talking about substantive procedure, what you're actually doing is you are testing those financial statement assertions, okay? And also last time, we also looked at the types of financial statement assertion. There are three of them: assertion based on transactions and events, assertions based on account balances, and assertion based on presentation and disclosure. Those are the three And these are the three types of financial transaction that we have. Today, we are looking at substantive procedure as it affects non-current assets. So what that implies is that when you are conducting substantive procedure for non-current assets, what where we'll be focusing on, or what we'll be focusing on, will be essentially on the assertion based on account balances. Because remember, when we discussed financial statement assertion, we said that assertion based on account balances relates to the statement of financial position. And you will agree with me that non-current assets are contained in the statement of financial position. Okay, so that is why we'll be looking at all those types of non-current assets, okay? And how do we perform substantive procedures on them, okay? So let's dive in and try to understand more about how this substantive procedure affect, or how do we carry substantive procedure on non-current assets, okay? Now, when tangible non-current assets are included in the same financial position at evaluation, a note should disclose the basis used to revalue the asset, okay, the date when the assets were revalued, and whether an independent valuer was involved in the valuation. And lastly, the nature of an any cost index that was used as a base for calculating replacement cost. Other disclosures that the note we have include the carrying amount of each class of asset that will have been reported if the asset had been reported using the cost method, and so if the asset had been valued at cost minus accumulated depreciation. All right. Then others are the revaluation surplus and any movement, sorry, coming, any movement in the surplus during the financial period. Okay. So what we are saying is this. Remember, in our IAS 36, when we talk about impairment, right? We said that at least the assets, okay, in an organization should be tested for impairment at least once a year. And if you are doing valuation, you agree with me that all what we have enumerated, or that has been have listed, are what will be carried out during the revaluation. You want to know what is the basis for revaluing the assets. All right. You want to know the date when the assets were revalued, because that the asset must be revalued before the audited financial statement starts. Okay. Before the audit engagement starts, they need to have done the revaluation. Okay, so that in the course of the audit engagement, they will be able to obtain information as it relates to the evaluation of the assets. And you need to note that whoever is going to carry out the evaluation of the asset must be somebody that is not their auditor. that person must be independent. Okay? He must not be an auditor, he must not be a contractor. He must be someone that is independent because if he's not independent, that means that whatever valuation amount or balances that he comes up with might be subjective. All right? Then also, the whole essence of impairment is to be able to record that the carrying amount as posted in the same financial position is actually the real value of those assets. Okay, okay. So the carrying amount is the balance that you have, the net book value that you have, okay, in your statement of financial position. All right. Now, and when you carry out evaluation, okay, when you carry out impairment, sometimes you also now, when you do carry out impairment test, right? Sometimes you result in what? Deficit. Sometimes you result in what? Surplus. That is, your asset would have been, the value would have increased, and in other case, the value would have what? Decreased. Okay? How you treat this adjustment is very, very important. Okay? It's very crucial to the auditor. All right? I hope you are getting it right. All right, so let's continue. Now, the principal risk of misstatement, that is, when I explained something when I was explaining, I was talking about planning, right? I was talking about audit risk. I said that um when you have audit risk is the tendency that the auditor will give an inappropriate audit opinion, right? And I said that there are three components of the audit risk. We have inherent risk, we have control risk, and we have detection risk, right? Now, inherent risk, I said that these are risks that by their nature, they are susceptible to what? Manipulation. And I give instances, right? Now, what you need to note is that when you have non-current assets in your books, it's subject to what we call inherent risk. Okay? So how do you ensure that whatever value or balances that you have in your financial position is actually the accurate amount? Okay? So when the management presents the financial statement and says that, oh, our financial statement shows a true, our financial statement does not contain any material misstatement, the auditor will ask them how, and they will point out to all those assertions, which the auditor will later test in the course of reviewing the balances that relates to the non-current assets. All right. So, and I said that management make the assertion, then the auditor, external auditor, test those assertions, whether they are what, whether they are correct or not. Okay. So these are the assertions that the auditor will test. Number one, completeness assertion. That is the risk that the assets owned by the reporting entity have not been included in financial statement. What that means is that whatever assets, not whatever non-current assets that you have included in your non-current assets, okay, they want to know that all necessary documentation as regards that asset has been what? Has been obtained. Whether the asset is yours or whether the asset is borrowed, okay, or leased or hire, okay, the documentation must be complete. The auditor will test that. Another auditor will also test is the existence assertion. That is the risk that the assets reported in the financial statement do not actually exist. So sometimes why we have this is that sometimes the manager can decide to play a fast one on the auditor if the auditor is not meticulous. All right, it does not have the attitude of rational skepticism. This can be an issue, okay, for the auditor. So for the auditor to be able to ascertain that those assets contained in the asset schedule actually exist, he must carry out what? A verification. That's what we call asset verification. And most times when an auditor visits their client, they usually put asset verification as one of the last thing they do on site. Okay? because they need to ascertain that those assets as contained in its asset schedule do exist. All right, the auditor will test that one after the other. That means you obtain the list of asset register, the list of assets on the register, then the allocation, the value, okay, and all of this. The auditor will go and check them because you need to substantiate that all the assets reported in the statement of financial position do exist. Okay. Then the next principal risk the auditor is also faced with is what? Valuation assertion. Okay. That is, it is a risk that assets have been incorrectly valued, which could be due to incorrect recording, inappropriate valuation, or incorrect depreciation calculation. Now, what that means is that um, when the auditor is reviewing the financial statement, there's every tendencies that it might, if it's not, if it does not have access operational skepticism, there could be instances where it will gloss over incorrect recording. What do you mean by incorrect recording? Now, there are some assets that are either leased, okay, or owned. If it's borrowed or leased, okay, that asset, what you have in the asset register, no, not in the asset register, what the value you're going to have in your non-current assets will be the value that you pay for the usage of that asset, because asset is anything that you use to generate what? Economic benefits, okay? Anything you use to generate economic benefit is an asset, okay? So what that implies is that they want to know, because if you add least an asset, what they expect to find in your statement of financial position is the lease rental that you pay. Okay? So they don't want the issue whereby you are going to now find the true value. In fact, you don't even need to have the full value of the asset. Why? Because the owner of the asset might not have shared the details or released the details of the true value of that asset to you in the first place. All right. The other thing that you also see is that sometimes you have incorrect or inappropriate valuation, and that will result where there is a relationship that exists, okay, between the valuer and the company. Okay, let's say that the valuer is currently working on certain projects for the company. Aside from that, that means that his independence will not be what will be in doubt. Okay, he will not be seen to be independent and will not be independent. Okay, that will affect that. And sometimes also the way the client will have computed their depreciation is the reason why auditors, when they go on field, they always recalculate. Remember that when you're talking about audit evidence, method of obtaining audit evidence, recalculation. So for instance, if the company or if the client has purchased an asset in the middle of the month and they put it to use in the middle of the month, the appropriate thing is that they should calculate the depreciation from the middle of the month where the asset was put to use, and not to use the whole month to calculate depreciation. Okay, that's what we are trying to say. So these are the things the auditor will carry out, and where he sees that the asset has not been properly, the division has not been properly computed, the auditor will carry out or will pass what we call audit journals on it to reflect the value that's supposed to be as the net book value. All right. So then the next assertion the author will also carry out is what we call what? Right and obligation assertion. And right and obligation assertion is the risk that in the course of discussing valuation, okay? And what that means is that there are times where you have assets that you cannot acquire. Okay, so what you do is that you list those assets because you want to generate economic benefit. So any machine, okay, equipment that you use, okay, to generate economic benefits is known as what? As an asset. So the author want to check whether due documentation or due diligence has been done as regards what? As regards the right to use the asset, and obligation is the author will request for obligation is to liability. The author will request for offer letter if there's a loan, okay, and also request for the repayment schedule to see whether the company complies with their financial obligation. Okay. And remember also when we discuss those things, I mean the financial assertion, financial net assertion at I mean when we are discussing chapter 6, that is audit evidence and sampling. Remember, I said that the third assertion, which is assertion based on presentation and disclosure, I said that is for both statement of financial position and statement of profit or loss, another comprehensive. I did say that, okay? So this second assertion will also be tested by the auditor. So the auditor will carry out test on the presentation and disclosure assertion. So there will also be a risk that the assets have not been correctly presented and disclosed in the financial statement. The auditor will use what? Substantive procedure to obtain evidence that the various assertions relating to tangible non-current assets are valid. Okay, because this actually relates to presentation and disclosure. That is the notes to the account. To be sure that the notes to the account contain the necessary information that will lead to what? The understandability or the comprehension of the information contained in the financial statement. Okay, so those are the those are the principal risk. Okay, that can lead to misstatement in the non-current assets. Okay, so we continue. Now, let's look at the procedure. Now, what we just explained were the principal risk. Now, we are going to go to what? The procedure. That means these are steps by steps, okay? So, the substantive procedure used by the auditor for tangible non-current assets will therefore be designed to obtain sufficient and appropriate audit evidence about the assertions, okay? The test will therefore be directed to carry out this completeness, to be sure that the information that you have there has not been understated, okay, or is incorrect. Number two, the auditor will also test for existence, okay, existence as to whether there are no overstatements, okay, that is, you will need to carry out physical verification of those assets to know their location, all right, and if the assets are not found, reasons for the asset not being found must be provided by the client to the auditor. All right. Are we together? Does anyone have any questions? They are good. Okay. So let's continue. So the test will also therefore be directed to the valuation. The auditor request for the valuation certificate. Okay, when the valuation has been done, whoever does the evaluation, the person must be an expert in the first place. I remember I talk about who expert is in chapter 6, right? I said an expert is someone that has what competence in other field outside accounting and auditing. Okay, so the auditor request for a validation certificate to be sure of the authenticity, okay, of the valuation activity or exercise that was carried out. All right. Now, in the case of land, the auditor will request for if there is a receipt of purchase. And sometimes you have what we call the deed of assignment, okay, or the C of O, all right? And also, sometimes when they've done survey, okay, the auditor will request for what? Survey document, okay? And you know you can get your survey document from the Ministry of, I mean, from State Ministry of Lands and Survey, okay? It depends on the way, what they call it in different states, okay? But in Lagos, we have the office of the uh, Surveyor General, and we also have the Ministry of Lands, Lagos Ministry of Lands and Survey, okay? So that's where you are going to apply to obtain the documentation on survey, okay? In the case of property, plant, and equipment and motor vehicles, right? In the case of these two, the auditor we need to check for what? The document of purchase. Okay, they're going to rest for what? Document of what? Purchase. And aside from document of purchase, The auditor will also request for other incidental costs that can be attributable to putting those assets, okay, to use. Remember, your IAS 16. That is not only the cost of purchase, but other incidental costs that can be attributable to putting the assets to use. So the cost of transport, logistics, commission or decommission, servicing, all of those things that were done initially to put the assets to use. All these costs must be what? Added together. All right. Then all of this will be done at cost. Okay. The auditor is checking at what? At cost. Now the auditor is checking at valuation. That means the auditor will want to what? Verify amount in financial statement with the valuer's report. So we want to check that whatever the valuer report says is what is reflected in the statement of financial position. You also want to also consider the reasonableness of the valuation. You know, when you're doing valuation, you have to put some assumptions. Okay, those assumptions you also want to see whether they are what, whether they are realistic. All right. Then you also want to check the evaluation are regularly what updated. You know, I said for impairment, you test for what? Impairment at least once a year. Okay? So the auditor wants to check that these things are done periodically. All right? Then the auditor also wants to check the accounting for the rise or fall in the value of revaluation. That's when it's going to do what? When there's what we call um adjustment, okay? Evaluation surplus or evaluation deficit. Okay. Then we go to the other area, depreciation. You also look at depreciation. This is for non-current asset. You know, it's only in non-current asset that you have depreciation and impairment. Okay. So you review depreciation rate for reasonableness in the light of the nature of the asset, its estimated useful life and residual value. Okay. So if you look at your assets, you know that for building, right? Sometimes you can see the useful life of a building can be 20 years, okay? For motor vehicle, might be 4 years, and some they even use their cars for 2 years, depending on the nature, okay, of the business, okay? So they also want to check the reasonableness in light of what? Calculation or reviewing the calculation of the what? And of the assets, okay? We want to see and the residual value. Okay, some assets have residual value, right? Then the auditor will also ensure that consistent depreciation method are in use. What that implies is that there are different depreciation methods, right? So what we are saying here is that um, this year you use sum of digits. Next year you use reducing balancing method. The upper year you use straight line method. Remember the accounting policy and estimate, okay? That says that is IAS 8 that says at any time that you are using any policy, okay, you should use them what? Consistently. You cannot change them unless there's something that is material happened that may result to that change. Otherwise, you keep using it year in, year out, okay? Then you review gain or losses on sale of disposal, all right? And the accumulated depreciation and impairment at the time of what? Disposal. Then you consider the possibility that assets are obsolete or suffering impairment. You know, when you talk about obsolete, let me give an instance. The makers of iPhone, iPhone 16 is about to come out. Okay? What that implies is that once the iPhone 16 comes out, okay, iPhone 15 Pro Max, iPhone 15, iPhone 14, iPhone 13, all those older ones, okay, they become what? Obsolete. Obsolete does not mean that they will not be of use again. What that means is that due to passage of time, okay, their value as what? Has dropped. And you agree with me that once a new phone comes out, let's say iPhone 16 Pro Max comes out now, most people will trade their old phone for that new phone. And if you even have the old phone, let's say you have iPhone 15 Pro Max in your store, that is Apple store, and you have iPhone 16, I bet you the value of iPhone 16 Pro Max will not be the same as iPhone 15 Pro Max. The reason is what? Because of what? Passage of time. As at this time now, let's say the iPhone 16 Pro Max is out today. That iPhone 15 Pro Max, the value will what? Will drastically drop. All right. So what that implies is that the author wants to, if there is a sharp increase, or I mean sharp decrease in the value of those non-current assets, then the author will note that that asset has has suffered from what? Obsolescence. Okay, the asset has suffered from what we call obsolescence. Okay, or they will do what we call impairment, suffer from what? Impairment. This is the carrying amount of that asset as what? Has dropped drastically. Okay, so all of these points, right? You must carry the client management along. Okay, you have to carry the client management along. Okay, in the course of discussion. The other thing you also need to look out for is what? Right and obligation, ownership. Right is to what? Asset. Obligation is to what? Is to liability. So let's look at right, which are the one that relates to what? Non-current asset. Your land. The author will need to verify legal documents, title of the document, lease agreement, if they are not the owner of the asset, the rights to use the assets, okay? Um, if it's vehicle, the auditor will verify the vehicle particulars or similar documentation. Vehicle particulars include proof of ownership. You don't want to see, are these vehicles owned by the company? Okay. And for other assets, the auditor will also examine the invoices, okay, and transfer of title document. Sometimes you might have been able to use this asset because of the kind of relationship or agreement that exists between the client and the owner of that asset. Okay, you also want to review those documents. Okay, then also you will review legal documents, bank documents, and other documents for evidence of loans, okay, that are secured by charges on assets. Remember in those days, when we were doing when we were still at elementary, we were doing accounts, right? There's what we call secured creditors. Okay, all right, secured creditors. So secured creditors are those creditors uh that they have a lien, okay, right of lien on the asset of the company. What that means is that um now you borrow a loan from the bank. When you borrow a loan from the bank, sometimes the bank requests for what? Collateral. Collateral means document to show that you are the owner of that asset. So in case there's a default, okay, or non-payment, they can take over the assets, okay? Because the essence of that is that in case you don't pay, that will that will be in place for the payment that has not been what? That are not being paid. Okay. So all of this, they don't want to know which of those assets have been pledged. Okay. Which of those assets have been pledged with with the loan. Okay. So you want to see those assets. Okay. It's very essential the auditor does this. Then, as per presentation and disclosure, the auditor will want to check that all the disclosures that have been made, that's notes to the account, that have been made are correct and clear. Okay. And the auditor will also request for the schedule, that is the asset schedule. Okay. And sees whether the non-current agrees to the figure in financial. So that asset schedule, you also want to see because it comes in as notes to the account. Most is part of notes to the account anyway, the asset register. So the auditor will now check the net value of those assets, whether that was the value that they finally imputed as the balances or carrying amount of those non-current assets. Okay, so that is some of the things that needed to be done. Any question? Any question? Okay, there are no question. We go on. So you have an example here. Okay, during the year ended 30th June, year six, construction acquired freehold land at a cost of 500,000 and built a distribution center on it using a mixture of subcontract and own labor. The distribution center cost a total of 200,000 to construct. The construction was completed by the end of April. Okay. Required. Set out the audit objective in respect of the above and the substantive procedure to be carried out to achieve this objective. So what you want, what this question is asking, because this is a likely exam question. They're going to set questions on substantive procedure. These are the type of questions they will set. You want to test your understanding of substantive procedure and essentially the audit objectives, okay? And those procedures that need to be what to be conducted to you to achieve those audit objectives. Okay, so let's see. So this is the answer. Now the land and the distribution center exists at 30th June year 6. Okay, so what are the substantive procedures that need to be done? Visit, okay? The editor will visit the site and confirm that the distribution center has been built and is in use. So it's not enough only to just accept whatever your client say. You need to verify and confirm. Okay. Then another thing you need to do, construction owns the what is it? Consortico owns the land and the distribution center at 30th June year 6. So what do? You inspect the land registry. You know, I said that you go to the Ministry of Lands and Survey to certify that the land actually belongs to Consortico. So for anyone that wants to buy land, once you buy your land, okay, or before you buy your land, the seller, the owner of that land, must have, if he has done survey, okay, or he has certificate of occupancy, which we call C of O, you will need to verify this document with the Ministry of Lands and Survey. It's very important so that you will not be swindled, okay? So you need the auditor will visit or request, okay, the land registry, okay, and request for the certificate, or write the third party for confirmation, that is bank or what solicitor. You know, when they draw some of these agreements for land transfer, okay, or land use, okay, they always use the solicitor, who are the lawyers, okay, to draw those agreements. Okay. You need to inspect correspondences confirming that local planning permission was granted and ensure all conditions were met. So what that implies is that it's not enough for you to only visit the land registry. We have in Lagos, we have what we call the Lagos State Building Control Agency. All right. They will need to ensure that the building has been what? Has been certified by the local planning authority. Remember those houses that collapsed at Ikoyi, those Ikoyi towers. Remember where the owner of the construction died along when those buildings cave in. Remember, you know, if you listen to that story then, if you were comfortable with that story then, remember that the man said that all those buildings in that area, the permission that they got from the Lagos Ministry of Lands and Survey and the Lagos State Physical Planning, okay, means Lagos State Physical Planning, okay, and Development, okay, was that you can only erect 15-story building in that area because of the topology of the soil of the land. All right. And remember, what did the man do? So when he got that order, when he went to confirm, they said that he can only do 15. He contravened that law and ended up doing what? 17. And they did what? The Lagos State Building Control Agency came and said that for this structure, right? Number one, you're using manual labor. Number two, you have contravened the act, and that place was sealed up. But because it's connected, as we always say in Nigeria, we have people, we have people, we have somebody that is connected to somebody that is very powerful. That seal was what? Was waived, and they continue construction. As a matter of fact, He was supposed to travel that day that he died. He just said that he went with his friend, that let me just visit the site and see how far they've gone. And mind you, houses around that place, they are sold in dollars, not in naira, because they are luxury apartments, so to say. And a lot of people have made down payments. You understand? No, I'm giving you these stories because of what we are doing. Okay, I'm not just trying to give you story just for that, for the fun of it. Because of the area we are discussing, so that in case you see something like that in exam, your mind will what? Will flash back and you'll be able to what? Understand what they are trying to do. So I was going to travel that day. He just said, let me quickly just breeze in, check what they have done, and move out. At that time that he entered, everything caved in. Over 30 people were died. Okay? So that's what we are saying. So when there's a contravention of the local planning permission, those are some of the things that could happen. Okay, that place can be sealed up. And in Lagos, it says that any place that building collapse, the Lagos State government seizes that building, that land. It belongs to Lagos State. Remember. Okay, so that is what I just need to explain to us. Then other things that, as for that question, expenditure capitalized in respect of distribution center. Now remember that you need to have what we call um you need to be able to capitalize some of your expenses, es- especially those expenses that are directly related to the construction of the distribution center. They need to be what capitalized. So you need to set your capitalization amount. Companies have capitalization amounts. When you buy anything, and that thing you bought, that item that you bought, is up to a certain amount of money, okay? Let's say 50,000. And and due to the nature of that item, okay, it can now be classified as an asset. I'm not saying that all items are capitalized. No, based on companies have different policies as per what capitalization. Okay, how they want to capitalize their assets. Okay, so all those costs that are incidental to bringing that assets to use, okay, will be what capitalized. All right. Then the editor, in the course of that, the editor will also discuss with management their policy on what capitalizing expenditure. That's what I just said. Okay, incurred in building the distribution center. It's not all the cost. So, for instance, let me give you an instance so that you understand. I like to be very practical in most time when I'm teaching. Now, let's say you're like this place now, building this distribution center. Cement, cost of cement will be capitalized. Do you understand? Then this one will not be capitalized. The element that they use, those laborers, if they use elements, if they use elements, if they use safety boots, it should not be capitalized because those ones are consumed. All right, they are consumed, and the number of years that they have might not be as much as that of cement. Cement, once you use it to construct a building, that building can last forever. That is the so there are reasons behind how you classify asset as what an asset or what can be written off at once. So you understand what I'm saying now? So cement will be seen as what? Will be capitalized, okay? Because it's part of what they use it goes into the building, okay? But items like uh helmet, crash helmet, safety boots, okay? Googles that they wear, okay? All those ones will not be capitalized. Why? Because they wear out easily because of use. Buildings don't wear out like that. Okay, I hope you understand. Later, we discuss with management their policy on capitalizing expenditure incurred during the building, the distribution center. Other things the auditor will also ask: a formal system is in place for the allocation and capitalization of construction expenses, and the auditor will need to test that system. Remember, when we talk about audit evidence, we talk about what walkthrough testing. as a method of what? Obtaining audit evidence. So when they say that they have a policy on catalyzing explanation, the auditor will request for that policy and demonstrate it, okay, and check that that policy is fully implemented. Another thing that we also ask for management as per this is you review example of invoices not capitalized during the period and ensure treatment was correct. So all those things, example I gave us now, let's say they bought a helmet or they bought safety boots, okay? All those ones will not be what? Capitalized, okay? Then the other area, that the distribution center, land and the distribution center are appropriately valued at cost. So the auditor will inspect completion statement for purchase of land. Okay. So when you buy a land, there's what we call uh, transfer. Okay. They will write a document, present a document that this asset, I mean, this land has been what, bequeathed or has been given to you because you have paid for it. So you will see that letter. They have released letter. Okay. The auditor will also obtain analysis of cost of building the distribution center. Okay. So all the costs incurred, cement, okay, water, tap sand, okay, iron rod, all of this will be what? Will be requested by the auditor to substantiate that all of these costs actually goes into or go into the construction of this distribution center. Okay. Uh, Purchase invoices for a sample of raw materials and subcontract costs. All right. Time record for a sample of internal labor costs. You know, some people, when they use those direct labor, okay, they pay them daily. And for a company that is involved in that construction, the project supervisor or the building supervisor should have a what? A record, okay, where he keeps all of this money that has been paid. But at the end of the day, everything must be aggregated, okay, to add to what cost, how much it costs to erect such a building. Okay. Then evidence in respect of any overhead capitalized. Okay. Overhead are expenses. Okay. Any evidence, all of them, they have what? Receipts or invoices as per the nature of the transaction. Then the auditor will recalculate the depreciation charge for the year, taking into account that the distribution center was not completed until the end of April. Their year end is what? Is December. Okay, but it did not complete. The building was completed in April. That means it will be what? Prorated. Okay. Then the land and distribution center are appropriately disclosed in the financial statement. So you have the land, you now have the what? Distribution center. So the land, we have the cost, its own cost. While the distribution center, we also have its own value. Okay. Then the auditor will also review the disclosures in the financial statement and ensure that they are correct and what? Clear as per those land and building. Okay. Then the author will ensure the schedule of cost agrees to the figure in the financial statement. Okay. Those are for tangible assets. Let's now go to intangible assets. Now, in the case of intangible assets, right? We also have substantive procedure for them. When you say an asset is intangible, that means you cannot feel or touch them, but they do exist. The classical example is the goodwill, purchase goodwill, patents, okay, patents, trademarks, okay? All of these are examples of what? Intangible. Branding, the examples of what? Intangible assets. Intellectual property, all these are examples of what? Intangible assets, okay? So the risks, though, what are the things that are with? There are also risks of misstatement and substantive procedure relating to intangible assets. Okay, example, assets such as goodwill and brand should be. Hello, hello, Augusta, please mute your mic. Augusta, please mute your mic. Thank you.
Sure.
Augusta, please mute your mic. Thank you. So the risk of misstatement and substantive procedure relating to intangible assets. Number, we are saying that assets such as goodwill and brands that is branding, okay, should be similar to those set out above in respect of intangible assets, okay? The emphasis of the substantive procedure will be on what? Existence and valuation, okay? And remember that only intangible assets that can be recognized in the statement of financial position are, remember all those things I said, these are the ones that can be recognized. You can have purchase goodwill, okay? Intangibles having a readily ascertainable market value, okay? Developmental costs subject to conditions set out in IS 38, all right? Then there should therefore be adequate audit evidence available to enable a conclusion to be reached on these assets, all right? So what they are saying here, if you get this right, what they are saying here is that once you know that these assets, these intangible assets are the intangible assets that we are referring to here are the purchase goodwill, okay? Intangible assets that have readily ascertainable market value and developmental costs that has gotten to a point, okay? Now, if these are the intangible assets that have been recognized, then all those risks, those principal risks that we discussed about, risks of um, existence, risk of right and obligation, risk of valuation, risk of which other one again? Completeness, okay? And also presentation and disclosure that we discuss for the tangible assets, tangible non-current assets are also applicable to these ones. That is what we meant by that. All right. Now, the main substantive procedures for the intangibles are these. We want to look at them now. The first one, test of details for purchase goodwill. So, goodwill, purchase goodwill is mostly happens when there is an acquisition. Okay? Like now that Providence Bank and Unity Bank, they have merged. Okay? So one of them had goodwill, or if both of them had goodwill, okay, they will look at the value of the purchase goodwill. So the value that they have will be the word purchase goodwill. All right? Now, the test listed below relates mainly to the valuation of purchase goodwill. So for the purchase goodwill, these are the tests that will be carried out, test of detailed transactions, okay? The auditor will confirm that the business was acquired and confirm the consideration paid for the building acquired, okay? What that implies is this. Sometimes when they talk about acquisition sometimes go beyond just the assets, the cost of acquiring that.
Okay, welcome.
Costa, please mute your mic, please. That is discussing the class. I was saying something. I said sometimes when you talk about purchase goodwill, one of the things that makes the acquisition cost to be high is always the purchase goodwill that is not seen, the unseen asset. Okay. Now, Providence acquired Unity Bank. Providence just started. They are not up to 20 years. They are not up to 10 years that they've started. Unity Bank has been in existence for a longer time. Providence Bank is mostly like a regional bank. Okay. It's mostly concentrated in the West. But Unity Bank is scattered everywhere. So obviously, Unity Bank had somewhat purchase goodwill. Okay? So they would have the Providence Bank paid for those goodwill because that means that rather than for them to go and establish branches scattered all over the country, they can leverage on the branches already as in existence by the what? Unity Bank. I hope you are aware of that. You are aware of that news I just shared. Okay. Then the auditor will also review the reasonableness of the valuation placed on the net asset acquired. Okay. So when there is an acquisition, they always value the what? The asset. Okay. So they will value the asset. They also want to check whether there are sense of there's what reasonably that is there are sense of what reasonableness. Okay, on those assets that they are very very reasonable in the course of evaluation. They will also check the calculation of the purchase goodwill. Okay, that is your purchase goodwill is what the consideration minus the value of net assets will give you that difference. What you call the purchase goodwill. So also we check that as well. The auditor will also review the possibility of an impairment having arising because sometimes if they've not been doing impairment, it may affect the value of the what? The net assets. Okay, the author will test all of that. Then also the author will also ensure that any impairment loss have been correctly calculated, okay, and recorded in the ledger. All right. Now, this all what I just explained now, those are what that relates to what? Purchase goodwill. Now, the second one is test of details for other intangibles. Here, they are excluding what? Developmental cost. Okay, that means they are looking at what they are looking at. Let's go up so that we understand. All right, sorry. What they are looking at is this. Intangible having a readily ascertainable market value. That's the one they are looking at now. Intangible having a readily ascertainable market value. That's what they are referring to. Okay, because they did not talk about the developmental cost yet. So the test for other intangible that other than developmental costs are similar to those that may be applied to tangible non-current assets. So the author will confirm the existence, the cost, and the client entity legal right to the what? To the acquired assets. Okay, the author will request for legal rights for you to say the owner of this asset. The author want to check it. The author will also check the amortization calculation for accuracy using the stated policy. Okay, the author will also consider the possibility that the assets are suffering impairment. Okay, this matter may have to be discussed with the directors of the client company. Then next, the author will also ensure that all impairments have been what? Correctly correctly dealt with in the ledger. Okay, these are the procedures that, aside from the other ones that they do when you are carrying out some procedure on on tangible non-current assets, tangible non-current assets, the one you have earlier discussed. Aside from that one, and this one will be what will be applicable in this regard. All right. Then you now go to the developmental cost or development cost. Now, test of detail for development cost. So IS 38, down that they talk about that about the condition in 38 earlier. This is what it says. IS 38 states that an intangible, sorry, let me move this thing. IS 38 states that an intangible asset arising for development or from development phase of an internal project shall be recognized if and only if an entity can demonstrate all of the following. Number one, the technical feasibility of completing the tangible asset so that it will be available for use or sale. Number two, the intention to complete the intangible asset and use or sell it. Number three, its ability to use or sell the intangible asset. Number four, how the intangible assets will generate probable future economic benefits. Okay. So what we are saying here is this: for you to recognize developmental cost, there are certain conditions that you must fulfill. One of them is that there should be what a technical feasibility of completing the intangible assets. Okay, and that it will be available for use or for sale. All right. Um, its intention to complete the intangible asset and use or sell it. The ability to use or sell intangible assets. All right. And how the intangible assets will generate probable future economic benefit. Okay. Then others are the availability of adequate technical, financial, and other resources to complete development and the use or sale of the intangible asset. And lastly, the ability to measure reliably the exploitation attributable to the intangible asset during its what? During its development. All right. So let me give you an instance. So if a company is a manufacturing company, okay, and they are trying to produce a product, a new product. Now, in the course of production, when they start production, that's what we call, we always have, most of these manufacturing companies always have research and development department. Now, the essence of the research and development department is to come up conceptualize ideas, new ideas. Okay. And once they conceptualize it, they are going to what? Embark on research. So what you need to realize that it's not all new conceptualized ideas that turn out to be what? To be positive, or that turn out to be what? To be complete. Okay. Some of those concepts or ideas are aborted in the middle way or at the middle way. Okay. Now, for those ones that are aborted at the, let's say they want to produce a product now, they want to develop a product, and they started, and all of a sudden, they discover that, oh, the cost of raw material, okay, to develop this product, when completed, it will be difficult for them to sell it because the cost price is very high and it's going to affect the selling price as well. So if there is a unanimous decision by management and the board saying that, oh, let us abort this decision, they are going to abort that decision. Okay? So all the costs that they have spent, they'll do what? They'll write it off. But let's say the product eventually saw the light of the day. What they do is that for them to be sure that it shows, I mean, it saw the light of the day, all of these conditions that I earlier explained will be what? Will be tested. One of them, they want to check the technical feasibility of completing the intangible assets. Okay. The intention to complete the intangible asset and use or sell it. The ability to use or sell this intangible asset. Okay. The intangible assets will generate probably future economic benefit. The availability of adequate technical, financial, and other resources. Okay. The ability to measure reliably the expenditure attributable to the intangible during its what? Development. So the audit test might include the following: discuss developmental projects with management, other relevant senior personnel, and other key stakeholders to assess the feasibility of the project or product. All right. Number two, that will be done: review the projections and forecasts for using resources and generating future economic benefits. Number three, assess production and marketing plans and whether a market or use actually exists. Number four, consider funding requirements to completion. Number next, whether the entity can actually be able to use or sell the assets. Okay. Next, you discuss with management. You discuss with management their intention to complete the asset and either use or sell it. Okay. Then number next. Sorry. Okay. Number next. Um, consider funding to completion.
Only from and like you went off. I don't
Uh,
know if
the,
it's only my
I was trying to explain, I was just explaining the audit test to be carried out during that developmental cost. Okay. So what you need to do, you need to discuss with management. So let me give an instance. So so there was uh I'm trying to do for an example now. Okay. Okay, let me use an example. We have DSTV, we have other digital television. Okay. Now, let's say a new digital television wanted to come out to take over the market from DSTV. Okay. Like example is the ITV that was in existence sometime back. Okay. The ITV came, was trying to outsmart or outdo DSTV. But along the line, because of some issues, right, they couldn't. So in that instance, the auditor will check, like an IT will now check, why did it not pull through to the end? We will ask the stakeholders, ask management. Then from there, we'll look at the projection and forecast. Then another thing is going to look at the marketability of that product. How many people are willing to trade their ITV for DSTV? okay, when the issue started, okay. Then consider funding requirement, that is how many banks are ready to put their funds out, okay, to finance such a huge project. Then whether the entity will actually be able to use or sell the asset. All right. They discuss management intention to complete the asset and either use or sell it. All right. Then contract, inspect development contract and record supporting and sorry,
Sorry.